Okay. Grading standard. Attendance and class participation 20%. Attendance 10%. Okay. And qualitative comment and suggestion 10%. So how active you attend the class discussion method. Of course, if you miss the class, since you cannot make any comment or suggestion, you will get automatically 0%. Okay, 0 about this. So it means class participation is important, but class participation is not enough. If you attend the class, you will get 10%, but another 10% you have to be active. Okay, and then presentation 20%. Okay, many of you already did presentation, and if you didn't make any presentation until now, you have to do the presentation. Okay, and if you think your presentation was not good, I think you know your presentation better than I. So if you think your previous class presentation was not good, and if you need another chance, please let me know, and I'll kindly assign you another presentation. Okay. So presentation 20%. Okay. And term paper 25%, and assignment and exam 35%. Weekly assignment and exam 25%. So actually it is more important class participation. Okay. So if you don't submit your homework, of course, I think your maximum grade would be like B. Okay. But don't worry, if you didn't submit your homework until now, you have many other opportunities from now on. So please do your best. Okay. If you don't submit any homework, then of course you will fail. Okay. Yes.
What do you mean there do not worry after assessment and grade? You said do not worry.
Which one?
On the top, assessment and grade, and then on the bracket you said do not worry. What does it mean?
You mean this one? Do not worry. Yes, I assume that you did all these requirements, of course. But if you don't I'm assuming you are a sincere student. Okay. But if you don't do that, then of course you have to worry about it. If you make your effort and if you do your best, of course, I'll say you don't have to worry. But if you don't do your best, then why should I be kind to you?
So if we miss some kind of homework or if we do good on the homework, but later we get a chance to recover.
Yes. Actually, if you didn't submit your homework until now, please submit your, so about previous homework, I think some of you didn't submit your previous homework, right? But it is not late yet, so please submit your homework, even though it is long time ago, like all the homework, okay?
Professor,
Yes.
the question about presentation. Presentation divides into two parts.
Yes.
What is reading presentation?
Yes. Reading presentation is textbook presentation. Okay.
So that means I did
Yes,
reading
you already
presentation.
did. Yeah.
But how about 5 pages?
Okay, that is about your investment idea, and you will get a chance about that about later part of this semester.
So we have two presentations.
Yes, basically. Well, for the 5 presentation, it will be 15-minute presentation. But if we don't have enough time, okay, if we don't have enough time, then I am making my like a 5-minute presentation possible. But anyway, just reading presentation, I think it will be more important. The textbook presentation will be more important. Any other question? So again, you don't have to worry about your grade. You do not worry about your grade. As far as you do your best. Okay? I'll count your effort. Okay? I'll count about your process of reach the answer and doing the homework. I'll not simply count about the correct whether your answer in exam or homework is correct or not. Okay? Not on the result. I'll count your effort. Okay? Process. So just do your best, and I'll be very kind about it. Any other question? Yes.
Question from the exam.
Yeah.
Do we have to do all the questions or can you go through each one? They are
Okay, midterm exam, just a moment, okay? Midterm. Okay. Yes, we have 4 questions, okay? Oh yeah, so 0 is basically about your term paper, so anyway you have to do it, right? So, okay, if we count this default homework, default problem, then we have 5.
But this is, we have to submit this too.
Yes. I want to check the progress of your term paper.
So why it says investment class only in number 1?
Oh, because part of these problems, I also assigned this problem to my other class, students in my other class, it is financial econometry. So I share some of the problem of this reason and I assign another additional problem to the other student.
You have to do question number 2 as well. Because it's all
Yeah.
reading, I think it's.
No, it also has English. There is 2 texts. One is written in Korean and another is written in English. So, which means you didn't start this midterm exam yet, right? Anyway, you have to submit until 10th. Because I gave you enough time for this midterm exam, okay?
Professor,
Yes.
can you give me a bit more information about question 0?
Question 0.
Because I told the last time about I will invest ETF, but you told me to correct like this. So I want to understand your expectation of.
Yes, so what is your investment idea again? Okay, please tell me.
Just invest ETF 200
Okay.
for maybe 3 years
Yeah.
continuously,
So why?
because it's I think ETF 200 consists with Codex 200, and I believe Codex 200 consists with very good stocks,
Why they are good stock?
because it is selected stocks.
How are they selected?
I need to check, but it's almost the same as the index fund growth.
Yeah.
So instead of invest my money into index fund, I'd rather invest Codex because it has low commission fees.
Yeah, but problem is that maybe, actually that is not always true. Anyway, even if I accept your hypothesis, why should I invest in Codex? Does it guarantee, and not guarantee, but do you think it will generate excess return over some cash or whatever?
Is that my problem? If I solve the problem about Codex 200,
So anyway, you have to show me, okay, you have to convince me that why should I invest Codex 200, right? And how can I make money by investing Codex 200?
otherwise I should correct my investment idea.
Yes. Definitely. Yeah. Any other question?
And do I use any statistic fact-sheet for the next midterm exam? I'd like to show some graphical picture, but I'm not still good at R programming, and I'd like to use Excel or
Okay, that is fine. Okay. Okay, if you are not familiar with R, and if you are good at an alternative packaging, then please use that for midterm exam. You don't have to use R. Any other question? Okay, let me set up next week's presentation. We have chapter 10 and 11. Okay. Any volunteer for chapter 10?
Next week, we have class.
Yes. Of course. Why not?
Because it's midterm week.
Yes, but we don't have in class midterm.
We have a week, like, it's kind of long.
Yeah, but I gave you like 2 months, right, for the midterm. So we have class next week.
So chapter 10 and 11 is for next week.
Yes. Any volunteer? Okay, that's important for your grade. Okay. Who didn't do the presentation? Okay, so do you wanna do the presentation next week? No?
Next week is midterm. When we need to pick up.
Yeah, but okay, we don't have in-class yet, right? So which means that we can do the class.
Like, professors.
To make the presentation, we need time.
Okay, so it means you have to prepare other.
There are like 4 exams and
Professor,
Okay.
usually professors who don't have in-class exam and teachers debate, they just cancel the class. Because they assume that we are working on our training.
Okay, please raise your hand if you wanna cancel. If you want me to cancel class next week. Okay. Okay then. Okay, no class next week. Okay. But then I expect you more quality output for this meeting. Since we don't have class next week. Okay, then chapter 10 and 11 next week. Okay. Who wanna do? Okay. Chapter 10 on 11, which one? Chapter 10, okay. Oh, by the way, okay, you just came. Okay, how about chapter 11? Who wanna do the chapter 11? Arbitrary pricing theory.
What is arbitrary price? What is arbitrary?
APT, it is called APT. It is a
Pricing model supposing without arbitrage.
yes. Basically, you can regard it as a one of the kind of multi-factor model. It's not difficult. Okay.
It's like law of money prices.
No. Okay. I mean, okay. Of course, you will read a book and then there will be a better answer. But of course, we can check Google and arbitrary pricing theory. If there is answer for Wikipedia. Okay. In finance, APT is the general theory of asset pricing that has become influential pricing. Oh, it is not informative. Okay. APT holds a linear. Okay, that's important. Okay, so APT argues that expected return of any finance asset can be expressed as a linear combination of some underlying factors.
So you use the linear equation?
Yeah, it is an APT. So APT is the asset pricing model, and it basically assumes that asset return. So if we know asset return, we know asset price next week. Right? Next week. So it is a pricing theory, and it assumes that the dynamics of prices, which is return, is linear function of some underlying factor. Factor means that it is a systematic risk that affects return of every asset in return. Anyway, if you read the book, you will easily capture that idea. So don't worry.
I'll do it.
Okay, good. Okay, so Minha and Nina. Okay. So, okay. Next week. Today is week 7 and then week 8.
Professor, I have a question for you.
Just a moment. No class. Okay. Okay. Yes.
For midterm, you said before, I think like you can do in team.
No. Everyone should meet. Don't misunderstand. Okay. Everyone should meet his or her own method exam.
But you said like in
Yeah,
homework,
but-
you should do.
Yeah, but except you can discuss each other about your answer. Not about your answer. You can discuss each other. You can help each other to do the meeting. Okay, but don't share the final answers. Any other question or? So again, it is not late. If you didn't do homework previously, please do all the homework. Okay. And solve it as soon as possible. I hope.
Another
Yes.
question for presentation. I saw there's about 20 chapters to presentation, but
Just a moment.
I think the student number is not.
Yeah, of course. I will not cover everything. Okay, I will up to this point. Up to this point, we will follow the book. Then I'll skip several chapters because some of the chapters overlap, like a derivative class or like international finance classes. So I don't wanna deal with the stuff you already learned or you will learn in other classes.
Then you mean you will lecture with the textbook in after several weeks?
Maybe, yeah. So for example, I will not cover these things. Chapter 20, 21, 22, 23rd, these things, I will not cover them. And I will not cover chapter 19. So yeah, equity valuation model, no. Yeah. And about bond prices and yield, maybe. Term structure of interest rate, no. I will not cover this because we already learned.
And we don't have to worry about the second presentation, right?
Actually, you have to worry about second presentation if you didn't do well in the first presentation.
You mean the presentation about the investment idea?
Okay? Yeah. Oh, not that actually. Of course, everyone should do that. And by second chance, if you didn't do presentation well about this textbook, I will give you another chance to do the presentation. Okay? So, for example, when you want to do the presentation about chapter 7, right? And if you think you are not happy with your previous presentation, and you can tell me you want to have another chance, then I will assign you any other chapter. Okay. I'm assuming that it doesn't mean that you did a terrible presentation. I'm not saying that, but if you think you did a terrible presentation, then you can have another chance. Any other question? And for your one, if you do another presentation, and then when I assess your presentation for grade, I'll count only the better one, not the average. Okay. So maximum. So it is like function of max of the quality of two presentation.
So you consider the bad one?
Better one, of course. If I count only bad one, why? If you do the presentation a lot, then the more presentation you make, the worse your grade will be, right? If I count the bad one. So that's unreasonable.
It's not sigma, right? It's not.
No, it's not single, it's a max function. Okay. So basically call option, okay? Call option. So your exercise price is making a presentation, okay?
That's what I'm going to check. Is that okay?
Number 12 is too easy actually. Okay.
So no, I cannot do it.
Actually, if you want to do the chapter 12, then you have to do chapter 12 and 13. It is okay.
Chapter 12.
12 and 13.
Both of them?
Yeah, both of them. I mean, both of them are quite easy. It is a lot of.
But then, like, other people who didn't present, like, they won't have so many chances.
If you think you feel terrible presentation about chapter 12 and 13, I give you another chance, okay? So what you are agree or not?
So if I tell you next week, then it will still be this offer, chapter number 12 plus 3.
We don't have a class next week.
Next week.
That's next week, yes. So please think over it. Again, there are a lot of questions about class and homework and midterm exam today. Any other question or any other issue? And please let me know your opinion if you think this class is too tough and I am willing to soften some of the requirements.
Sure.
Okay, so what do you want then?
Some collaboration between students.
Collaboration. Okay, if I allow you collaboration, then there is a possibility of free riding. Okay. Do you have any idea how can I prevent the free riding issue? Free riding is moral hazard problem. If you have any
Always
good
these
idea,
kind of issues.
oh, beg your pardon?
There are always these kind of issues in everything.
Yeah, that's why I don't allow you the collaboration, right?
But like maybe our performance will improve.
Oh, beg
So
your
like
pardon?
if
Our performance or our output will improve.
Okay, so how do you want to collaborate? About what?
Very directly.
homework, midterm.
Over the midterm, okay? Okay, midterm. So,
Midterm ideas.
so you want a teamwork about midterm, okay?
And isn't it better to do two-person do presentation on one chapter?
No, I think that's maybe good for those who prepare the presentation, but from the perspective of audience, that is not good. From the perspective of audience, we prefer only one presenter on one issue. Okay? So one presenter per issue, that is the best. So how many of you want teamwork about the midterm exam? Yeah. Okay, 1, 2, 3, 4. Okay. But there are people who don't want a collaboration on midterm exam. Okay, therefore,
Majority always wins.
okay, pardon?
Majority always.
Oh, no, this is not democracy. Democracy means we have to sometimes respect the minority opinion. Okay. Okay, then I have an idea. If you wanna do the teamwork about
Or you can like do
beg your pardon?
3 questions out of 5. Like you can give us option.
Actually, that's a creative suggestion. So you wanna do actually it is a default, so everyone should do it. So maybe 2 out of 4 or 3 out of 4.
2 out of 5.
There are 5 questions.
Yeah, I mean, so it is a default question.
Okay.
Number 0 is a default.
So
So
2
everyone
out of
should.
4.
So 2 out of the 4.
Number 4.
And no teamwork, right? Or no teamwork.
Yeah, your answer should be set. But you can
2 out of the 4. Okay, I think that is not a good idea because it is possible that someone already started midterm exam long time ago and already finished all the questions. Okay?
You can ask, like, overall.
Yeah, but I think there is a peer pressure. Peer pressure, so the peer pressure of like oppressing minority opinion now. So okay, I have an idea. Okay, I will allow the teamwork. But first, let me be clear. Everyone should solve every problem. So we'll find questions, and I will allow teamwork. Team up to 2 people. Okay, so 2 people can solve with one answer sheet for this homework. And in addition, okay, and I need to compensate those who prepare midterm exam independently. So you will have higher chance, larger chance of getting better grade if you do the midterm exam alone. Okay. Is it fair? Okay. So you have option. So at least I give you the option, right? You have an option to collaborate, but in this case there is possibility of not discount actually. Yeah. So basically, I will give you option to solve the problems independently, and if you do that independently, you will have a higher chance of getting better grade. Okay. Is it clear? Yeah.
Another suggestion.
Okay. Okay.
And I think the class here, they are willing to learn a lot, but
Okay.
because of there's a lot of mathematical proofs and things, I think, because we didn't learn differentiation in high school.
Yeah, but now you already made a right program about differentiation and integration, and that's enough. Okay, so you are already expert in calculus.
So from now on, we don't have any more mathematical stuff.
We will have mathematical stuff, of course, and I will assume that you already know calculus.
When we do that, can we do let's like it's just a little bit slower so that
Yeah, I mean I'll be slow, but it is your responsibility in some way. You have to stop me. You have to ask me questions. Okay. So if you don't know like some stuff, just raise your hand and I'm willing to explain it. Any other question? Okay, anyway, if you have any good suggestion about this class, please send email to me. And then who is today's presenter? Okay, today's presentation is Chapter 8, Hemin. Why don't you start first? Thank you.
Okay, good morning guys. I'm Hemin, the first presenter of today's class. And I'm going to explain you about the optimal risky portfolio. And I'm the one who feels like I'm an idiot in this class always because of many mathematical stuff. So I will try to make it easier, skipping the complicated mathematical proofs. So some of you might feel like it's too easy, but please understand. So as we learned before, there are two types of risk in the market. One is the market risk, like the earthquake of Japan. It's also called systematic risk, undiversifiable risk, or yeah. And the second type of risk is idiosyncratic risk. That is firm-specific risk. So like if Steve Jobs is sick and the news is well known and Apple's stock price gets lower. And the important thing is below. If the firm-specific risk of the assets in the portfolio is independent to each other, diversification can reduce the idiosyncratic risk, but not the market risk. Please understand this concept.
Can you slow down?
Yeah, of course. So if you see the visual graph, panel A shows that only the idiosyncratic risk exists. So if the diversification is successfully done with the many assets, as the number gets higher, then the risk could be reduced almost to zero. But if you see the panel B, since there is market risk, which is the risk you cannot reduce, so even though the unique risk gets lower, the market risk still exists, so you cannot reduce the risk. Like there are very complicated things to understand how we find the optimal risk portfolio, but we can also understand this by a very simple example using two security portfolio. So this is basically, we are assuming that there are just two kinds of funds in our portfolio. One fund is D, like it's composed of debt securities, and the another is E, it's composed of equity securities. This box shows the basic information about the D and E. And please look at the white notes. I guess you guys need to be familiar with the information, like the W means the rate on the bond and the rate on D and E. And of course, R means the return on D and E. And we need to get the portfolio return, RP, and the basic formula is in the above all the things. So return of the portfolio is weighted sum of each return of each asset, and simply by adding the expectation to each part of the formula, we can get the expected return of the portfolio. And below one is the formula for the variance of the portfolio. I guess rather than understanding how this formula is made, I guess it's more important to understand how you can modify this formula from now on. So. And some of you might already know very well, but I didn't know about this very well. So the variance of D and variance of E means the risk. So variance is basically how the expected return and the actual return of each asset is different. So how much difference is there? So you can understand like if the standard deviation goes up and the risk gets higher, and if it goes down, the risk gets lower. And covariance means how much two variables, in this case D and E, change together. And actually it's kind of hard to use the covariance, so we have another tool for this, like rho. Rho is correlation coefficient. It's basically the measurement of covariance. And rho is ranged from -1 to +1. If rho is +1, that means two variables go exactly the same way. And if rho is -1, it goes the opposite way, exactly the opposite way. And I guess we can see the range. So the first formula is the formula we saw for the variance of the portfolio, and using the covariance RDRE is rho sigma D sigma E, we can simply change the formula like this. And to make the formula easier for us, we need to assume that what value our rho has in this case. So please look at this one. I'm going to assume that what if rho is 1, and then what if rho is minus 1. So if rho is 1, if you see this formula, I guess my handwriting is not very good, but I guess you guys can come up with very familiar thing in this formula, like I guess this is the only formula I still remember from the high school. And WD, the weight on D, and sigma D, we can see this as A, and this as B. Then this is A square, B square, and A, B. So we get variance of portfolio is but it's possible only if rho is 1. Are you guys with me? So if rho is 1, that means like I said, the way securities change are exactly the same. So the securities would be perfectly positively correlated. That means no diversification. So it's basically same as just one type of fund in the portfolio. So if rho is 1, we can get the standard deviation like that. And you can assume, you can refer as if rho is below than 1, then the left part will be smaller than the right part of the formula. So the standard deviation of the portfolio will be less than the weighted average of the standard deviation of the assets. That means the risk gets lower. And on the contrary, if the rho is minus 1, you can get the standard deviation like that, the absolute value of WD sigma D minus WE sigma E. And if rho is minus 1, the securities would be perfectly negatively correlated, which means it's hedgy asset. So you can see as the amount of number gets lower because of the minus and absolute. So you can see how hedgy asset affects the portfolio. It lowers the risk a lot. This is the table of expected return and standard deviation with various correlation coefficients. So we have 4 types of rho, -1, 0, 1.3, and 1. And if you see this part, the yellow part, if WD is 0 and WE is 1, that means we only invest in the equity security. And on the contrary, if WD is 1, we only invest in the debt security. So that means the expected return of the portfolio is basically same as the return of each asset, so 8% and 13%. I guess it's easier to see this visualized graph. So in here, it's the x, the horizontal axis basically means how much weight you give on the stock security. So same as equity security. So it ranges from 0 to 1. If it's 0, then it has 8% of return, and if it's 1, it has 30% of return. So it's same as the table we saw before. And you might wonder why there are other ranges before 0 and after 1. That can be understood by the concept of short stock selling, and I hope you guys can Google more about this concept. Yeah. So if you see the curve, please look at the row is 0.3 curve. Then you can see from 0 to 1, the curve gets lower first and gets higher again. That means the risk of this portfolio gets lower and then gets higher. So as the diversification develops, the risk changes. And if you want to get the minimum variance portfolio, like the minimum variance means like 0, variance is 0, you can see the triangular point at there, and that was possible because the row was -1. So hedge fund. Row is 1 means you didn't do the diversification, and row is 0.3 means you did the diversification. And the yellow part means if you do the diversification, you always get the lower risk than before. That is important. So we can get the portfolio opportunity set with the different weights invested in the assets. And you can see the dotted lines, the two lines in the left side has the lower standard deviation, so lower risk than the other two like curved lines. Now we can think there are 3 securities in portfolio. Like before we saw the 2 risky securities, and we assume that there are 2 risky securities and 1 risk-free security in this portfolio. Before we see this graph, I guess, as you know, CAL, capital allocation line, measures the risk of risky and risk-free assets. And investors can make the return by taking on a certain level of risk, of course. And it starts from here, risk-free rate, and that could be understood by example of like treasury bill issued by U.S. government. So this graph shows there are 2 CAL lines, the linear lines, and the curve. So we can see the optimal choices of complete portfolio lie on the highest possible CAL, the higher line. And if you look at the P, the meeting point of 2 lines, that is the optimal risky portfolio. So if you are the investor, you must aim at like making the slope steeper, even steeper. So by maximizing the slope, investors use this formula. It's simply expected return of portfolio minus return of risk-free asset and divided by sigma p, the optimal risky portfolio's standard deviation. Yeah, from these slides, I guess there are 2 slides more, and we need to get the standard deviation and expected return and the weights using the optimal risky portfolio and you can do it by like kind of complicated computer programs, and I guess it's enough to like know the basic concepts, so I will just skip this part. Yeah, this is end of my presentation. Do you have any questions? Thank you.
Thank you. Yeah, I'm sorry to say this, but actually, June couldn't prepare for presentation for chapter 9, about capital asset pricing model. So I need someone to present chapter 9 for next week as well. Any volunteer? So we have 2 volunteers. Okay. So I'll give you one more chance. Okay. So this is serious. It is appointment, right? So you break your commitment. So don't do that again. Okay. Abdullah, can you explain contango and backwardation? Beg your pardon? Explain contango and backwardation. Okay. Abdul Mui, explain contango.
How it's fashion classes.
Umer Rajab, what is contango? Contango. Okay. What is this?
Easily changeable assets.
Angelica.
Well, I googled it, contemporary versus to the market condition. Well, this is the
I
easiest
Googled
one.
it too.
Okay, so read your search results. Okay.
Well, because it's, yeah, I want to be honest. Yeah, contemporary versus the market condition, where the price of a forward or futures contract is trading above the present short price.
That's wrong.
Well, it's-
So in this case, Google result is erroneous.
Wikipedia is wrong.
Beg your pardon?
Wikipedia is wrong.
Wikipedia is wrong.
because you refer to itself often.
So, I mean, when you do Google search, okay, there's a tip, okay? Wikipedia can be wrong. So, when you do search, check at least 3 sources, okay? And if they are not consistent with each other, then there is a problem. Okay? Actually, I don't want to say Google and Wikipedia is wrong. There are several definitions about the content and backwardation, and there is one of them, and that is not what I explained. Okay? So, I mean, my explanation, the definition of contango I explained last week was the more dominant, actually, more popular conventional definition in the field, okay? But not for everyone. Okay? There are some people who disagree about that definition. Anyway, the definition of contango I explained to you last week was, Hemi, what was it?
Yeah.
What is the contango? The definition of contango that I explained last week.
I don't remember.
You don't remember? And is there anyone who can remember? Okay.
You explained with gold and oil.
Yes.
So the future price of oil will be going up, but it's more worse to invest. It's less worse to invest.
For
So
oil,
yeah.
that's exactly opposite of what I explained. Okay.
Yeah.
Professor, so when the future price is above the expected future spot price,
That is called normal valuation. Okay.
so you missed the period also.
The opposite of more.
예, 성규.
Content before last class was the future price slope is going up as the maturity goes far, and degradation is opposite as the maturity goes far. The future price slope is going down, and because when the maturity closer, because the future price will go up, and that's why you told us we should invest in degradation.
Okay. So maturity, future price. Is it contango or backwardation? No, it's contango. Okay. Please. Okay. So there is clearly miscommunication. That's it. So everyone understands exactly opposite definition of what I explained. Okay, so that's one of the most important stuff in the commodity and futures market. Okay. So okay, let me rephrase my question. Again, let me go back to the previous Ferrari question. Okay. So okay, if you have a Ferrari, okay, and if you drive the Ferrari to the club either in Hongdae area or Cheongdam-dong area, okay, then you are likely to be a hot person, okay. And suppose Ferrari become even hotter item. Okay? Suppose Ferrari become even hotter item in Cheongdam-dong and Hongdae area somehow, right? People are crazy about now Ferrari even more than before. And do you think that will generate even more content or even more memory? Okay, if your Ferrari example is not good, then let me go to this example. Okay. Okay, so gold is in contango. Okay, gold is in contango, and crude oil is in backwardation. And suppose now, of course, suppose there's a new technology now available. So if you have a crude oil, now you can eat the crude oil. And suppose there is technology such that now crude oil become a very delicious food now. Okay? Then what's gonna happen to backwardation? Okay. Do you think this? How do you think this structural backwardation will change? Now you can eat the crude oil. Okay? Crude oil is now delicious food. So like this.
I think it's opposite.
Why?
Because the crude oil is very delicious. Everyone wants to the crude oil in spot. Right now, and the further the maturity is, the price will goes down.
Right, exactly. Now we have no opposite. Now we have a correct answer, okay? So suppose if you can eat the crude oil and suppose crude oil becomes a delicious food, then it becomes even more valuable, right? Because you can eat the crude oil now, so everyone wanna hold the spot, right? Hold the commodity right now instead of futures contract. So in order to make people hold the futures contract, we have to give them more premium, right? So futures price should go down because less and less, fewer and fewer people want to hold futures contract, right? And to make people hold future price, it should be low, so we have to generate, we have to ensure higher return from the future price. Yes.
The backwardation product, any goods for backwardation means having the good is better for the investor.
I mean, okay, so if we're going to the previous formula for Ford contract, so Ford price is spot price exponential over R plus C minus Y and T, something like that, right? So I'm assuming continuous storage cost and continuous convenience yield, right? So if R plus C is greater than Y, then what's going to happen? If R plus C is greater than Y, if we have a large T, this will go up, right? So if we, in this structure, we have something like this, shape something like this, right? And if R plus C is less than Y, then we have structure something like this, because we have more big T, we have a small f. So this happens if we have a large convenience yield, right? Large benefit of holding a commodity instead of futures contract. So in that sense, it's supposed to have new technology. So if we can drink crude oil, right? It means that people wanna have more and more crude oil. So in that sense, having a future position is like renting the underlying asset to other people. So it is like a compensation. So it means we have a steeper valuation, so which means that if we have a future position on the crude oil, we can expect even higher rolling return, which is basically compensation of not having the commodity right now and renting the commodity to someone else.
So your definition to contango is the interest rate plus continuous to storage cost is larger than yield, continuous yield for.
No, actually, there is another definition. It's one way to explain the pattern of the contango. The definition of contango I want you to remember simply is, okay? The longer the maturity is, the lower the future price. Okay, so it is a snapshot. In the Google definition, okay, in the Wikipedia definition, it is slightly different. Okay, so let's go to Wikipedia. Okay, contango. This x-axis is basically time. Okay, it's the flow of the time. Okay, so as time goes, it means that as time goes. Okay, so it is today, it is the future maturity. So as time goes, backwardation means futures prices go up, and contango means futures price tends to go down. So we have different x-axis. Okay, any question?
So this definition is correct too?
It is correct too, but in this class this is wrong. Okay. And actually the definition I told you is more prevalent and more influential definition. So of course it would be good if you can remember this, but if you can remember only one stop, then please remember the definition I told you. Okay, not this one. Okay. And last week, I wanted you to show some clip, but it didn't work. Let me try again. I think it is available in my MBA class. I think it, okay, it works.
I'm Bob Pisani with this week's ETF 101. When it comes to commodities, your returns could be affected by a phenomenon known as contango. When commodities are in contango, prices are higher for contracts that have later delivery dates. Remember that many of these commodity ETFs hold actual futures contracts. As the current month contract expires, ETF managers have to sell the current contract and then buy the next month's contract. But there's a potential cost involved with that. Take crude oil futures as an example. Suppose the current spot price is $40 and the next month's contract is $44. When rolling over to the next month's contract, oil prices would have to rise 10% to $44 before the ETF's performance would break even. Buying an ETF holding a basket of contracts with various different delivery dates instead of just a single front-month contract can help minimize the effects of contango on your portfolio. And that's this week's ETF 101.
Okay, so CN definition of CNBC is same to mine, not to the Wikipedia. Okay, let me have another one. I think this one is more instructive. Yes.
The U.S. oil fund is designed to track oil prices, but over the last 2 years, while the ETF was only up 7%, crude rallied 135%. What the heck is that all about? Some call it contango. NASDAQ Global launched a commodities index fund this week that reduces the potential negative impact of contango. Jan Van Eck is president of the firm. He's here along with Bob Zani. Jan, what's contango?
Contango is the shape of the futures curve. You can buy oil out 1 month, 3 months, a year.
Yeah.
It depends a lot on which contract you buy. And contango is when the futures price is higher than the nearby spot or next month out contract price.
Is the futures price always higher?
No.
Ah.
When they were building these indices in the 70s, everything was backwardated. It gained you about 4% a year in the indices that were created.
The one thing about contango is when you're rolling over into a futures contract, at the point at which you roll over, when you have contango, it benefits the seller because the buyer of that contract has to roll over and pay more money. And that's the problem we've been having with these ETFs. As they roll over, when you're in contango, the buyer pays a higher price, the seller benefits. So the question and what you're trying to address here is how do you deal with that? Because what you want is something that tracks the price of the spot commodity, not the contango.
Right, and this is well known. So the solution is constant maturity indices, which means they invest throughout the commodities curve, not just the front month. And for example, the index that we track has a tenor of 7.7 months. So we're investing an average of 7.7 months out along the curve. And we're not the only fund company to have a product like this, but the first generation indices, the Dow Jones, UBS, the S&P, CMCI, or GFCI, have major problems.
But even here, you're not getting a perfect match with, for example, if you want to buy, if you were to bunch 12 future contracts out a year,
right,
it wouldn't match perfectly the spot.
Exactly.
Right. How do you get around that problem?
This is a much closer fit. If you look charts, this is a much closer fit. It'll be good enough. It'll be good enough.
Why are you launching it as a mutual fund?
We need to wait for regulatory approval to get an ETF out the door. So there are some other constant maturity products out there, but that's what I really push. Look for constant maturity. There's hundreds of billions of dollars in commodities these days, and a lot of the institutions have fixed this through the swap contracts they do with Morgan Stanley and Goldman Sachs, but the average person doesn't have a great selection, and we're saying look for constant maturity.
And the important thing here is that it does not have a problem when you own the physical. For example, they're going to launch a copper ETF. That's not going to hold copper futures, or at least the ones that are going to hold physical.
No known spot. And also the cost of ownership of true spot is really high. It's like 4 or 5% for crude oil, copper, things like not for gold, because the content per ounce is very high. But that's the exception.
The cost of ownership of the physical is high because of storage?
Storage, yeah, the storage, yeah.
So you would not, now, let's come at that from a slightly different angle. In the past, these ETFs, the creation of these ETFs, many people feel has created liquidity-fueled bubbles as cash stampedes into the new ETF or whatever.
Right.
Can we anticipate that's going to happen with copper, aluminum, zinc, the industrial metals that Bob tells us are coming on the ETF front?
when these commodities are made available to a larger pool of investors, yeah, you see price movement. I mean, I can't guarantee it, but we do see that effect. Now, I think that wears out over time, but there's pent-up demand that the ETFs are accessing. But the most popular ETFs are the gold bullion one. That doesn't have this contango issue, right? They're owning a spot, so.
Let me just ask about the tax issues here of holding them in a taxable account versus a 401k, for example.
Right.
What are the tax issues around holding a commodity like this?
Well, you have the collectibles issue, right, with some of the ETF. Our fund is structured as a regular mutual fund, so you have regular dividend distributions, long-term capital gains stuff.
Okay, I've got to leave it there. Thank you very much, Bob. Thank you as well.
Okay, so very clear explanation about contango. Okay, I have a Okay, so when we have backwardation, backwardation means that as time, suppose this structure of backwardation remains the same for the future, then maybe 1 year later, maybe we have exactly the same backwardation. In that case, if we invest in the asset showing backwardation, and whenever we update our future project, which means we call it rolling over to the next contract. So suppose we are here now, and 1 year later we come in here, right? And in that case, the future contract is expiring. So we have to sell the expiring contract, and then we have to take another position for the 1 year, right? In that case, actually, we sell because if we buy future contract for this one, April 04, and 1 year later, in May 04, actually April 04, now it means that maturity, it is like maturity just now is spot price, so basically we are here, right? So which means that we are selling our expired position at high price, and we buy new long-term contracts, new contracts, expiring 1 year actually at lower price, selling high and buying low, create extra return. So it is rolling return from future position. So we can make money investing backwardation to the asset, assuming this structure remains the same. Okay? But there is actually one challenge to make money in these futures contracts. The problem is that spot price can change a lot, right? So if like oil price is very volatile, right? But if spot price of oil changes, then what's going to happen to this graph? Suppose spot price of oil goes up, then what do you think is going to happen to this one?
Slow shift.
Actually, not exactly. Maybe slope remains the same. It depends. But if spot price suddenly goes up a lot, then it is likely that entire curve may shift up together, right? Because future price should go up as well. Maybe they don't go as much as the spot price, maybe, or maybe not. But one thing we can say for sure is that this entire curve can go up or go down depending on the change of the spot price. Okay. So it means that in order to make money in backwardation, okay. So if we invest in asset in backwardation, basically we can expect excess return by rolling over this curve, right? Rolling over this curve. But the problem is the spot price, right? The volatility spot price. Then the question is, how can we squeeze out? Okay. How can we squeeze out this rolling return and hedge out the spot risk. Okay? So basically, suppose this slope, this structure remains same, but the only risk is entire going up, entire going down. So it means that we wanna squeeze out the return from this, from the position, from rolling over the position, and we wanna hedge out the risk of this entire curve shift over shift down. How can you do that? Bakjuan, what are you doing? Are you doing this smartphone? What was my question? Okay. Okay, it is, you can use your smartphone and you can do the game in the class if you want, of course. But you have to take this part of your really your brain. Okay, class participation is very important part of this class. So if you do you can check Facebook, okay, or Twitter with your smartphone, but it will lower, okay, your grading, your score in the class participation. Okay? So you lost already something. Yeah. Okay, who can answer my question? Yes.
So, we're worrying about the crude oil price goes down. What if we short sell the crude oil when we buy the backwardation contract?
Okay, that's a nice suggestion. Okay, nice suggestion. But how can we short sell the crude oil? I mean, it is okay. Basically, it is easy to short sell crude oil futures, right? But crude oil itself, it is very hard to short sell, right? It is commodity. It is some physical asset, right? So I mean, basically, it is right. You have a right idea. Maybe we can, in order to hedge the risk of the spot price, one idea is to short sell this spot itself, right? But if that is difficult, we have to find something alternative, something similar to that idea, but something more implementable. What is that? There is actually many ways to do that. Many hedge funds did this strategy a long time ago, and I heard this kind of strategy doesn't work anymore because too many people do that. So one idea is, of course, we want to short the spot, okay, short this crude oil itself, right? But that is not possible. Alternative is actually to find the asset, which has very high positive correlation with oil price. If we can find that asset, okay, if we can find that asset, instead of short selling the oil itself, we can short sell that kind of asset, right?
For example,
So for example, what kind of asset will show very high correlation with oil price? What? Car? Energy? Yeah, but energy is, I mean, I think it is even more difficult to short sell the gas or something, right? Natural gas. How about stock? Is there any stock that has very high correlation with
Oil companies.
Yes, exactly. Yeah. Yeah, oil company. Right. So we can short sell, for example, like Royal Dutch Shell, BP, and something like that. Actually, that was called pair trading strategy sometimes. The pair trading is basically find two closely related assets, like oil futures and oil company stock price. And if they deviate too much, okay, suppose oil price go up and somehow oil company stock price, suppose oil futures price go up a lot, but suppose oil company stock price didn't go up that much, then we expect the two prices should converge in the future. In that case, what we can do is we take long position on the oil company and short position on the oil stock, oil futures, right? That kind of strategy called pair trading. Okay? Pair trading is very, it is classic strategy for hedge fund, and somehow it is getting more and more popular in Yeouido. Yeouido is financial district in Seoul, right? Nowadays, in a lot of finance funds in Yeouido, certainly take high interest in pair trading. Right? I don't know why, but anyway.
And what about all other investors also use the same strategy?
Yes, so
Shell and
that's what I'm saying, right? Because there is too easy, right? Too easy so that we even undergraduate students, right? You cannot understand. So everyone, so people have to be more creative, right? Relationship between oil futures and oil fund, that is too well known, right? So we have to find something else. Right? We have to develop some other smart idea of the pair trading.
Yeah, I have a question. While you show us the video, CNBC, they are explaining contango and edit. As the future price goes down, the seller will benefit.
That is a slightly misleading. Right? That's slightly misleading. That part. Okay.
When you say slightly, and
anyway, future prices go down, right? If we expect the future price to go down, anyway, the seller will always get the benefit, right? But it doesn't matter where you are content or valuation, okay? Right? We should sell something and that asset price go down, seller happy, right? It is not closely related with content or valuation per se.
Professor, you're saying that crude oils are validation for this graph, but if the crude oil price goes continuously up, it can be changed to contango.
If stock price goes continuously up, which means that, I don't know, in that case, maybe this curve keep shifting up in the future, right? So again, we have to distinguish. It's a snapshot. It's a snapshot picture today, right? And what we are talking about is like dynamic. This shape of this graph, shape of the gold, whatever, this oil, it is not related at all. Actually, it is remotely related, possibly, but it has no direct relation with our expectation of the future spot price, right? The shape of this gold or shape of this crude oil, it doesn't say much about what's gonna be tomorrow or 1 year later price of the oil or gold. This relationship is just determined by, actually I deleted the relation between interest rate, storage cost, and convenience.
So,
Yes.
how about the world demand doesn't like
World demand will affect the price of the spot price. And of course, future price is also the function of the spot price.
and the suppliers?
Yes. That also affects price of the spot, and eventually can affect the price of the forward. Right? But the slope itself doesn't say much about the future supply or demand of the commodity. That's very important. Okay. And I explained about theories about contango and everything, and I think this is the place I stopped, right? And actually, low return is basically you can regard it is kind of return generated from the term structure of the futures price, like valuation and contango. And this graph shows that this annualized low return can explain the compounded annual excess return much, right? So of course, even if there is a risk of the spot price, still this low return from the position, return from the structure of the term structure of the future price matters a lot in determining excess return of the future position, because we will be positive slope. The higher the low return, the higher excess return we can expect. Therefore, if we go to the previous slides, Previous slide, this one, right? If we believe the previous graph, since backwardation, we shows backwardation in this case, there's more chance, there is some chance that we can expect high price for oil in the future, maybe. For contango asset, higher return from the position, futures oil futures position. And in this case, gold is contango, so it is likely, there is a tendency that we can expect negative return from this gold futures position. And actually, now gold is contango. I mean, always contango. And one explanation is that now people regard gold just as money, not jewel. Okay. And in that case, since it is just money, there is no convenience yield in some sense of having the gold itself. Right? Convenience of the gold is maybe having a gold and decorate myself, right? Having a ring, right? And something like that. But that is less and less important. And more gold is regarded as a currency. And therefore, it is not surprising that gold is almost always shows content. Yes?
Question. The expected excess return showed us include the low return.
Low return plus, okay, let me go back to the previous slide. Okay. So basically, okay, the return from the position, returns from the futures position is the sum of low return plus spot return. Spot return is the change of the oil price, and low return is the change of the oil future price because you are updating your position. If we add them, then it is excess return. It's by definition.
And the positive relationship between excess return and low return is quite easy to understand.
Not easy to understand.
I mean, kind of.
Yeah, quite easy to understand. Yeah. But problem is that if this is part return is much more than important this, and if this part is very volatile, the statistical relationship between this and this will be insignificant. But this finding is that this is not that insignificant. Right? The part return is still important, but still the relationship between low return and excess return is still strong.
Professor, can you explain what's the relationship between spot and
So,
return?
yes, so thing is that excess return, okay, you invest, suppose you invest in oil futures, and tomorrow oil futures will change, right? And between today and tomorrow, there will be a return from your position, right? And that return can be decomposed into the two parts. One is the change because of the spot price, another one is change because of your rolling and your return because of the the other component is make a low return, right? Low return generated from the structure of the term structure. Because between today and tomorrow stock price will change, of course, and that will surely change your future price. And in addition, okay, from between today and tomorrow, now you have 1 day short-term maturity becomes 1 day short-term, right? So it has impact, right? So that should affect your future return as well because of the structure of the term, because of the term. Any other question?
I have one other question about low return.
Okay.
Volatile.
Low return is
Term structure of the backwardation is.
so low return. Yeah, low return can be volatile if the term structure itself changes. Okay, so real return is basically if we go back to the so if spot price is volatile, okay, volatile, then this entire curve can go up or go down. But if the slope of this graph doesn't change, basically real return doesn't change. But if this slope somehow getting flat or steeper, something like that, then it will change real return, and that will generate volatility. Okay? And actually there is no guarantee that tomorrow this term structure of the commodity price will remain same as it is. That may change. The structure may change tomorrow or 1 year later. Okay, so
I received 2 emails, one from Kazakhstan embassy and one.
what? Which embassy? Canadian embassy?
No, Kazakhstan. I'm from Kazakhstan.
Oh, Kazakhstan
Yeah,
embassy.
and it didn't say like you have to live, but they said if you're worried, we will let you go.
And Aurelia is French, right?
Early is French, but she's studying in Canada at her home university actually. It
So
was
her
one of
home
the-
university suggested her.
Actually, if you see, like the French guy we had before, he also left.
Yeah, Adrien, yeah.
Adrien left to France,
Yeah.
and a lot of French students left.
Yes, I know. But what if remaining students? Right?
Well,
It makes remaining students very miserable, and myself as well. Right? So we are exposed to nuclear, radioactive materials, and we are dying, and you are being South Korean happily ever after, and you even want to grade from this class.
Professor, what 5 years later Korean government say, oh, we are sorry, but there was some risk for.
Yeah, of course. But then you will be healthy. Yeah. Then of course, in the case, of course, you are healthy, we are unhealthy. Instead, we have a good grade and you have bad grade. It isn't fair. I think it's unfair to the Korean and remaining students, right?
Well, we're risking our lives, so we have to.
Yeah, right. And you are just run away, right? And why should I compensate you for with a grade?
But actually, International Cooperation Office allow students to live now, and they.
Yeah, of course, I allow you to leave now, but
they
it's my
say that
discretion
we can
to
take
give
our
a grade or
courses
not.
online. This is one of the suggestions.
Yes, okay. It is your discretion, right? To follow the suggestion or not. It is up to you, right? And it is actually my right to have a grade I can give you.
So you're probably going to fail people who are going back to their home countries because of the.
I don't know, actually I'm thinking about it.
But we should know it in advance, like before you fail us.
Okay, so please send me the official document or official letter issued from your home country or home university.
I'm a regular student here, so if Hanyan write an official paper that they allow me to live, you will accept that?
Yeah, then why don't you show me any official document from your home country?
Okay.
Then I'll think about it. Okay. But please, I mean, you have to know that, okay? Things basically grade is for those students who take this class, regularly attend this class, and to the all the requirements, not for those students who leave the class. So you should know there will be some discount while they're in any case. Okay. Actually, I know it is actually a very big issue in Japan as well. In Tokyo, okay. I also worked in Tokyo, Asian headquarters in Lehman Brothers, and there are many international organizations in Tokyo and multinational businesses in Tokyo. And after this nuclear crisis, many foreigners, from the perspective of Japan is called gaijin actually. Foreigners left Tokyo for their own safety, while their Japanese colleagues or other colleagues remain in Tokyo, remain in the city, and do all the work. Actually, even in addition to their work, they have to take charge of the work of those who left the country, right? Of course, I'm not sure about this, but some people worry about radioactive risk and they think they are risking their life, right, for the company or whatever. And then after this nuclear crisis become less serious, I don't know whether it's less serious or more serious nowadays, but many foreigners actually came back to Japan again to resume their work, and guess what would be the mood in the organization or team, right?
If you check the latest news, it actually didn't become better. There,
Yes, I know.
the level of the radiation got up to 7, which meant it
Yes, I know. Please don't scare me anymore. I know. I have a kid. You know what? I have a kid myself as well, so I keep track of the news.
So yes.
Not only for the safety myself, but also for the safety of my.
So when you leave the country, can you tell us that you're leaving?
Oh yeah, of course. If I flee this country, and I will let you know, and I'll give you all April every year. If I run away from this country, but that wouldn't happen shortly. Okay? And so I'll think about it, right? And you know, I want to be everyone to be professional, right? It is business class. And this is very serious issue in many Japanese multinational firms right now. And the mood in those organizations is very harsh towards those foreigners who left the country because of the crisis, right? Anyway, I'll seriously consider about, anyway, please send me the official, anything official to me.
I will bring it from the international corporate.
Okay. Yes, please. Okay, any other issue? Who else want to leave this country?
I have another question.
Okay.
About the weekly videos when you get the videos, you said you were gonna post the your lecture on YouTube.
Oh, I think they are still working on it, and I was very curious about when videos are available. And actually, if I am too embarrassed about the video, then actually I believe it. Anyway, yes. As you know, we are recording this class and this lecture, right? And it will be posted on the web, but I don't want to be embarrassed. So if I look at the lecture and I found it too embarrassing to me, and I'll seriously reconsider, putting this lecture on the web.
Does the video include when you ask us questions and when we say you don't know? Is it
I'm afraid, but yes, I think so. I think it
Will they not censor our face or?
actually that's a very good idea. I want to hide my face as well. Yeah. Anyway, any other question? Okay. How about Poland? Any official? About nuclear.
I'm officially a Belgian citizen.
Oh, I'm sorry.
I'm
You're
Belgian
Belgian.
national.
Okay, but you are studying in Poland, right?
I'm born in the Netherlands and I study in the Netherlands.
Okay. How about that?
And they are not really concerned. And if you look into nuclear science and look about the things that are dangerous, it's the gamma radiation. And it's probably not gonna be severe over 1,000 kilometers away, which we are. And the other thing is the nuclear fall down, the dropout from the sky.
Right.
And that is not dangerous for you directly. It's only when it influences the food there on the fields, which you eat. I don't think Korea is much trouble.
Okay, thank you for comforting me. And other students. Okay. Okay, about next topic. Okay. Yeah, so my previous question was, how the head pathways can feed out the role in the body. One is the penetrate. One possible option is penetrate. Okay, now another big stuff for commodity future, which is inflation hedging. I think actually, I think some of you actually asked me about a CNBC clip. Okay, CNBC clip is available for everyone. So I will show you. CNBC is actually very good source. Okay, CNBC.com. In the trading room of the investment bank, they tune into this channel like 24 hours, 7 days a week. It is always on. In the trading room, in the suppose this is the trading room and every trader is like trade, and on the corner of this room there's a big screen, and in the screen CNBC is always on. So CNBC is actually a very important source of the news in the sector. Okay. Anyway, video, and we can do the search about. Let's find the topic about inflation and commodity. Okay. And the trading day good. And then video. Should Fed raise rate? Inflation and commodity, right? So it is recent news. So no, actually it is okay. Inflation and commodity. Inflation. Parsing China inflation. There's no news for inflation and commodity. So anyway, you can do the search on the CNBC and you can find topic whatever you want, and you click and you can see the clip like this. I'm not sure whether it is relevant to topic or not, but why don't you try? Okay, I'm not patient enough. Anyway, you know what I'm trying to show you, right? So whenever you are interested in some news or current issue, please use cnbc.com.
Professor, can you suggest some other websites where we can find information related to us?
Yes. So again, in the field, in industry, the most influential source of the news is Bloomberg and CNBC. Bloomberg for text news, CNBC for audio and video. But for Bloomberg news, actually, you have to subscribe, and it is extremely expensive. So Bloomberg is, I assume, not available to you. In that case, the alternative would be
Marketwatch.
what?
Marketwatch.com.
Oh yeah, that is another good source. In my case, actually, I'm not interested in every news, and I'm interested only in some subset of the news, right? So in that case, I use Google News, right? In the Google News, you can set up a keyword, and whenever there is news about the keyword, they will send you, they'll update the news in the Google webpage. So actually, this is my strategy, but if you want a more organized source of news, I just, MarketWatch is a very good source. Another one is, of course, New York Times business, like Reuters business, or those are also.
How about Bloomberg?
Bloomberg is, so paid version of Bloomberg is very good, but for the free version of Bloomberg, it is actually not. It is reasonable, but it's not. I don't know. I mean, they hide most important and valuable news for the paid users. So. Any other?
So these are for like only news articles. How about like academic articles?
For economic?
Related
to. For academic articles. I mean, like CNBC or Bloomberg or those business news also discuss economic news a lot. And if you are interested in academic literature, academic discussion about an issue, then what you can do is you can go to scholar.com. Scholar Google, actually scholar.google, what? Google.com. Okay. And Scholar, Google Scholar, you can type like, if suppose you're interested in inflation and commodity, you can type keyword, and then they show you the inflation. It show you the articles about inflation and commodity. And to find what is relevant, what is influential article or what you can do is you can check this one. How many times it is cited, actually. I want to change it to English. Okay. So again, you can do the search and then you can check this one, cited by 33. Okay, and cited by 59. So this seems like, oh, it is a book. And cited by 70 times. So it means that it is kind of, a lot of people read this article and cited this. So you can check this, okay? Keyword and check how many times it is cited. Yeah, there are beliefs that commodity is good to hedge inflation, right? And if we expect a lot of inflation in the future, the usual suggestion for the investors is to buy commodities, right? And indeed, people worry a lot about inflation, right? Because Korean government actually there are a lot of liquidity even in Korean economy and globally because there are a lot of liquidity and there is concern about inflation about that, and therefore recently commodity prices went up a lot in line with the fear, inflation fear. Okay, so let us seriously check how good our commodity portfolio is to hedge inflation. Okay. First, to find the relation between inflation and commodity portfolio, first we have to know what exactly mean by inflation. Inflation is like rising price level, but when we actually measure inflation, we usually use the CPI, Consumer Price Index, to measure the extent of the inflation, right? And this is the how Consumer Price Index, CPI, is composed, right? In the CPI, housing is maybe the most important part. And another important part is like transportation and food delivery. Right? And in terms of growth sector, it is service like 60%, energy commodity is 3.5%, food commodity 14%, and other commodities 20%. So actually there is like misalignment between these three. So the component of the CPI, Consumer Price Index, can be categorized in two ways. Commodities has about 40% weight, right, in CPI, and service have like 60% of the weight. Okay, so 6% of the CPI inflation is determined actually by weight, and commodities only 40%. And energy commodity make up only about 4% of the CPI, right? In this case. But as you can remember, in Goldman Sachs commodity index, energy index is like almost 40%. Right? So there is already misalignment. Anyway, when food commodities constitute about 40% and other commodities account for remaining commodity exposure of the CPI. Clearly, a broad-based commodity futures index like GSCI, okay, exclude many items measured in the CPI. For instance, the single largest component of the CPI is the owner's equivalent rent of the primary residence, like housing, right? But there is no index for housing prices in commodity, GSCI or other commodity indexes, right? So there is misalignment. This mismatch between composition of a commodity futures index and CPI may limit the ability of commodity futures to be an effective CPI inflation hedge. Right? So since the composition of commodity index and the CPI is different, maybe we have to suspect whether commodity index is really good to hedge the inflation. And this is actually relationship. Have commodity futures hedged expected or unexpected inflation or not? So in this case, y-axis is GS Goldman Sachs commodity index excess return over risk-free rate, and y-axis is year-to-year change in inflation rate. Right? So it's basically change in inflation rate. And if we take a look at the relationship between change in inflation rate and Goldman Sachs excess return, actually there is some reasonable relationship. The R square is about 40%. So about 40%, okay, inflation rate can explain about 40% of the change of the GFJ excess return. Actually, we can say it the other way as well. About 40% of the variation of the inflation can be explained by GFJ excess return.
So only in this case,
What do you mean by only?
like you said 40% is it fixed?
Given this data period from 1969 to 2003. And so between these like 35 years, there is 35 years, basically commodity can explain around 40% of the change in inflation. So there can be a reasonable relationship. Okay, but actually it is only up to year 2003, right? And if we extend the period to year 2010, maybe I think the relationship get stronger. I think. Anyway, because the inflation beta of the commodity futures portfolio is simply a weighted average of the portfolio constitutes inflation beta, a better way to understand the behavior of the broad-based commodity futures investment is to look at the inflation sensitivity of individual commodity futures. Okay. Which means that, okay, again, this GSCI commodity index is basically portfolio, right? And it is a relationship between portfolio and portfolio. CPI is basically, it is not portfolio of financial asset, but it is basically portfolio of some stuff that we care about inflation, right? So it is relation between portfolio and portfolio. So in order to find the relationship between commodity and inflation beta, what we can do is, instead of checking the relation between portfolio and portfolio, we can check relation between individual futures contract with EIN inflation, right? And what we already know is that the correlation between individual futures is very low. No? They are very low, therefore it generates high diversification return, right? If you can remember. So it is very important to check individual relationship between individual commodity futures and inflation as a whole. So instead this graph is good, but it is maybe not that informative. So actually this is the multiple relationship. This is individual relation between commodity futures and inflation, right? So what we want to do is we want to check the change of this commodity future, individual commodity future, and the change in the actually change of the inflation rate, the change of the inflation. And then for T-stat, when T-statistic is usually greater than 2 in absolute value, we can say they have kind of significant relation to each other. Very significant. So we can check T-statistic which is greater than 2, and we can see that this energy and livestock, okay? Energy and livestock has statistical significant relationship with inflation. And another one is industrial material. And heating oil, in more detail, heating oil, cattle, strong relationship. And then what else? Silver. Okay, this is very strange, but silver has strong negative relationship with inflation, right? So, although many people believe that commodity investing in commodity, basically many people assume that if we invest in commodity, basically we can hedge the risk from inflation. Many people think that, but actually this is not exactly true. Only couple of the assets in the commodity index actually matter to hedge the portfolio. All other things are really not that important. There is some assets even have a negative relationship with inflation. So I think it is kind of large implication to fund manager. So suppose you are a fund manager, and if you expect a lot of inflation in future, and if you want to bet on the inflation, you have to invest not in commodity index, but it's individual like energy and livestock. Now the question is, why might some commodity futures, okay? There are some commodity futures are better hedged to inflation than others, and the question is why? Okay? With the usual caveat that these results only describe a specific time period, the specific time period from 1982 to year 2003, okay? The previous figure shows that average real returns are highly correlated with unexpected inflation beta. And in fact, average real return explains 67% of the cross-sectional variation of commodity futures unexpected inflation beta. And commodities such as copper, heating oil, and live cattle had positive real return and high unexpected inflation beta. And commodities such as wheat, silver, gold, soybean have negative real return and negative unexpected inflation beta. So the argument is that, okay, the finding of this paper is that some assets, some individual futures are better inflation hedged than others because they have a higher real return. So they argue that, the authors argue that, okay, maybe the determinants of the relationship between inflation and inflation hedge is actually real return, which is generated from term structure of the futures price. And this shows the picture. So this x-axis is the compound annualized real return. So again, if we have something backwardation, real return would be high, contango real return would be low. And y-axis is unexpected inflation beta. Y-axis is basically sensitivity between inflation and the change of real return. And it shows that if we have a high real return, okay, if real return is high, then it has high sensitivity, high relationship between inflation and individual future. Which means that if we want to hedge, inflation risk, if we expect high inflation in future, what we can do is we find assets with high backwardation and invest there. If we expect low inflation in future, what this finding suggests is that we have to invest in assets with continuity. Actually, the authors of this paper didn't explain why the futures contract with high real return is better inflation hedged than the others. But anyway, this is the finding. I think it is the open question. Why there is a relation between real return and inflation? Right.
It's possible possible to see the inflation as the spot price movement. When inflation rate is high, the spot price will go up, and in the backwardation's case, the spot price plus the real return would be the unexpected inflation beta, and in the contango's case, the low return would be negative, and negative part, and the spot price movement from the inflation is cancelled out, and lower than the backwardation's case.
Yes, there is one possibility, but we don't know. And one thing I want to add is that actually the change in spot price and change in term structure of futures price is not closely related to each other. And there will be another challenge which you argue. So I think if inflation gets serious and serious, maybe many newspaper or digital magazine may suggest that maybe it's time to invest in commodity index, something like that. Right? Then then the way you can respond is that the relationship may be not as you get, and moreover, you can ask, okay, what is the roll return of your commodity index? And if roll return is high, then you can say maybe the commodity portfolio is maybe good hedge, or if roll return is low, if the roll return is low, then you can think their argument is wrong. Yeah.
Question for R scalable or class index.
Okay, just a moment.
I remember the R scale is kind of hedge effectiveness of hedge effectiveness, right? But I think the 0.4322 is not effective.
Depends on eyes. In many relationship in finance, actually, R square 33% is actually not that low. Okay, but of course, it is really not that high. So it depends on the eyes of the people. And of course, when you say about hedging ratio, maybe it's totally different issue. Suppose you are hedging your stock position with some other derivative. In that case, the hedging ratio should be very high. In that case, right? But I mean, inflation is not itself traded asset. So since it is not traded asset, therefore, I think it would be very hard to find a portfolio that has very high R square root. Yeah.
Is this correlation also true for Korea or Europe?
No, it is a global. Right? It is global. GSCI is a global, and Goldman Sachs commodity index. Right? It is the most popular and influential commodity index, and it is, I think, U.S. inflation rate. Yeah. It is not a lot.
CPI combination for US, right?
Yeah, U.S. So actually, this is not about Korea. It is U.S. CPI. Yeah. Okay.
And the table you showed us in the.
You mean this table?
Yeah, left parts. Each securities future contract, right? Or spot.
You mean this one? It is future.
Could the silver inflation correlation, yes, -1.
Yeah, that's very interesting. I don't know why.
Is that due to the two brothers who sold all their silver a long time ago?
I don't know. But actually, this data only up to year 2003, and from year 2003 to year 2011, silver is actually the best performing commodity price, right? And from year 2003 and from year 2011, both the inflation rate is high. Therefore, if we extend this data today, I think the relationship may turn into the palatable.
That's the reason why it's so strange.
Yeah, yes, right. Because people usually think gold or silver or precious metals are good.
The price goes up, actually they have to be on the return price.
Yeah, that's our guess, but it has negative upside return. So that's interesting. I think we can check again. Let's check CNBC. Okay, like gold and inflation. Okay? So even in this case, gold and the inflation change has is minus T stat is minus 0.95, which is negative, but it is actually not statistically significant. So if we believe this result, inflation and gold price are independent of each other. But people usually think investing in gold is a good strategy to hedge from inflation. Let me check the CNBC, Financial Factor, Commodity Tomorrow. Gold plus. Okay, let's check the most recent news about the gold and inflation. Okay.
Welcome back to Fast Money. You're live at the NASDAQ markets. I do want to take a check on Google's move in the after-hours section. Of course, Google out with earnings, and it did look like it disappointed certainly on the expenses side of things. Colin Gillis, remember I 370 words from the CEO Larry Page. We got a number of emails in saying that the Gettysburg Address was only 273 words, and so therefore it doesn't matter how many words, it matters what he says.
An excellent point. Our viewers
So thank you to our viewers. Yes, exactly.
Less is more, apparently.
Apparently, could be.
That's good for you. And if it's said from the heart.
Moving on. Let's take our position on Bank of America. Bring in Morgan Stanley analyst Betsy Broxick, who covers this.
I mean, it is not a news about what, so anyway. Strange.
I don't really watch you already your course website. I remember when PIMCO fell to every treasury bond, there was an argument.
Yeah, but it is not about commodity, right? So I'm interested in news between commodity or gold and inflation. Anyway, let's move on. Okay. Anyway, to summarize the finding. So, time period specific analysis of the inflation hedging ability of the specific universe of commodity futures is a number of observations. First, individual commodity futures have experienced varying exposure to unexpected inflation. Second, the unexpected inflation hedging efficiency of an individual commodity future has historically been correlated with rule return. Okay? And third, the ability of the commodity futures portfolio to serve as an inflation hedge is driven by the composition of the portfolio. Okay. Fourth, a portfolio that historically maximized the ability to hedging inflation focused on commodity futures that are difficult to store. Commodity futures that are difficult to store will have high convenience yield, therefore they will likely to have backwardation, which means they will likely to have high rule return.
I found Silver Thursday. And Silver Thursday was when the brothers William Herbert Hunt and Nelson Bunker Hunt were sons of billionaires. They bought silver and they dropped it on the market.
Right. So yeah, that's actually something we can share all together. Silver Thursday. Yeah, so maybe it explains why we have negative relationship between inflation and silver. So it occurred on 1980. Yes. An event that occurred in the silver commodity market, a steep fall in the silver price led to a panic on commodity futures exchange. So there is steep fall in the commodity index, and this period is maybe we observed high inflation during this period. So statistically, maybe we find a negative relationship between silver price and inflation, right? And yes, I remember this is very interesting. Yeah. Yeah. So basically, they want to corner the market, silver market. Yeah. Yeah, something like that. What happened to them? They were ordered to pay. Wow. Okay. Good. Thank you for the information. Next. Okay.
Professor, can you go to the previous slide?
Beg your pardon?
Previous slide. Can you go to the previous slide?
You mean this one?
And the fourth observation. Fourth.
Okay, so again, the authors of this paper find that the higher rule return, the higher the relationship between inflation and the future price. So to hedge the inflation rate, we want to invest in assets with high rule return. Right? And which assets have high rule return, which assets have high rule return. And those assets with very steep valuation. The asset with valuation will have higher rule return, right? And then question is what asset will have valuation, and valuation is generated by high convenience. And one determinant of high convenience is ability to store. How easy to store. So the more difficult of the asset is to store, they are more likely to be high. It is difficult to store, though it is likely that they will have a high chance that there will be disruption on the supply of those commodities. Therefore, it is actually more and more likely to have the assets, the commodities. And then traditional risk measures do not drive commodity futures return. Actually, it is related with what we will learn next week about multi-factor model. In the again multi-factor model or like APT or they say that we can decompose excess return of an asset with a linear combination of some underlying factor, right? That is basically multi-factor model. And capital asset pricing model is one factor model because in that model that we have only one factor, which is market factor. Okay. So what the authors of this paper analyze is that what kind of asset pricing model can explain commodity return from commodity futures. So they want to explain the excess return from the commodity future with like multi-factor model. And in academia, the most influential multi-factor model is farmer-friendly three-factor model. In the farmer-friendly three-factor model, we have these three factors. HML, it is called value factor. This SMB is called size factor, and this is actually market proxy for market factor. And size factor is basically SMB size factor is basically excess return of the small stock over large stock. And HML is excess return of the value stock over most stock. Okay, so they are most influential multi-factor model. So these authors check the relation between this and farmer-friendly three-factor, this market factor and size factor and value factor, and they couldn't find many significant relations with each other. Therefore, the multi-factor model for stock market may not explain the excess return of the futures market, commodity futures. And they also check, the authors of this paper also check the relationship between excess return of the commodity futures and bond factor. In bond market, we have also multi-factor model, and the most influential multi-factor model in academia is basically two-factor model. One is term premium, and another one is default premium. And again, even this bond factor, they are slightly better than stock factor, but most of assets do show significant relationship with bond factor. So the bottom line is that we cannot explain, okay? We cannot explain the exact return of the futures market, futures prices with existing multi-factor models for bond and stock. Yeah, and I think I explained this already. Okay, and then about pattern of the excess return. It's so slow. Okay, about pattern of the excess return. One interesting finding is that the roll return is actually getting smaller and smaller. Okay, the roll return is getting smaller and smaller, and which actually drive the excess return smaller and smaller. One case is that since many investors bet on the roll return. Betting on roll return meaning that we invest on asset with valuation and short sell contango, right? And this is too easy. That's very easy strategy. If many people do that, maybe they drive down the return you can expect from the rolling. I think maybe they are not important. Okay, another one. Okay, I think this is maybe interesting. And the author suggests how we can make money. How we can make money with commodity futures. In commodity futures market, in the most well-known, maybe the most well-known strategy, investment strategy for commodity market, for commodity portfolio is actually momentum and betting on the term structure of the futures market. Okay. First, about momentum strategy. Momentum strategy is basically a trend following strategy. Momentum strategy means we buy assets which performed well in the past and selling those assets which performed poorly in the past. So, which means basically we take long position on the winners and short position on the losers. Of course, our case is today's winner will be tomorrow's winner as well, and today's loser will be tomorrow's loser as well. And actually, that kind of momentum strategy works pretty well. Pretty well in the commodity space. So our momentum strategy typically goes long on asset after prior returns have been positive, which are winners, and goes short on assets after prior returns have been negative. And this figure shows the payoff to strategy of going long the GSCI for 1 month if the previous 1 year excess return has been positive, and going short the GSCI if the previous 1 year excess return has been negative. So in GSCI we have about 20 futures, right? So we take a look at the last 1 year return. If they are good, we buy. If they are not, we sell. And the return from this strategy is like this. So from year 96 to year 2004, the return from the winners, okay? So we do this strategy monthly. The winner generates this return, and loser generates this return, okay? And then we can actually decompose this into two parts. Year from year 69 to 82, and from 82 year 2004. Right? And again, they are return from the winner, return from the loser, return from the winner, return from the loser. So therefore, if we take a long position, if we buy the winner, past 1 year winner, and sell the past 1 year loser, basically we can expect excess return of this amount, right? From 1962 to 82. And we can expect this return from 82 to year 04. So historically, momentum strategy worked. Actually, this kind of momentum strategy even works in the stock market in US. Interestingly, in South Korea, momentum strategy didn't work. And this is again the momentum portfolio, and then this trading strategy through each month 12 categories of GSCI based GSCI and based on previous 1 year return. So we have 12 categories of GSCI based on sector. So we can check those return from the 12 categories based on previous 1 year return, and we can sort them from number 1 to number 12, right? And then we can then track the 4 GSCI component with the highest best 4 and the lowest worst 4 previous return. And suppose we do this kind of rebalance monthly, and they are the return. This is not. Anyway, this light blue is actually, let's begin from this yellow green. Yellow green is best for commodities, right? So best for commodities performed well. And this dark is worst for commodities. So long short strategy means that we take a long position on this and short position on this. The long short portfolio is sum of this and this, which is the light blue. So historically, which means that this momentum strategy works very well. So if we invest $1 in year 1983, and if we do this momentum strategy monthly, then that $1 would grow around $10 20 years later. Okay. And by the way, this red line is benchmark, is like equally weighted average. It is a kind of return we can expect if we take equal position on the 12 portfolio. Yes.
Why didn't the strategy work in Korea?
About the momentum strategy on stock market, there are not enough research about that, and actually one of the least literature, which is done by U.S. economist, American economist, he argues that Korean people are rational. Since Korean investors are very rational, so since they are rational, so if momentum strategy works, every Korean would do that. Therefore, in Korea we cannot expect that kind of momentum strategy. Okay, I don't believe it. I think there will be better explanation about that, but still it is open question. Okay. And in Europe, momentum strategy worked for the past like 30 years. Even in Japan, it worked. I checked it myself. And it worked in Japan. Somehow it didn't work in Korea. I don't know why. Definitely not because Korean investors are more rational.
Is there any research on China and India?
China and India momentum strategy works. Actually there is no publication about that, but I did the investigation in Lehman Brothers because there was a hedge fund which are actually client, and they want me to check momentum strategy in China and India, and actually there is momentum profit in those countries. But anyway, I have to add a disclaimer. Momentum strategy worked in the past. It doesn't mean that it will work in the future. Okay? So please don't use momentum strategy from now on. Don't use your own money to do the momentum strategy in the US market. Okay? It worked in the past, and there's no guarantee it will work in the future.
Can you use this for topic?
Topic for what?
This strategy, can we use this strategy to research more and use it for accounting for our investment?
Yes. Okay. The momentum strategy for you, other people, please don't do that, right? This for me.
This question was for overall.
Oh yeah, so it is one example, okay? And then this is actually more impressive result. Actually, yeah. Okay, I go in 4 slides. Anyway, let me wrap up the class at this point, and good luck to your midterm exam, and see you in 2 weeks. Okay, thank you.